I'm with Denise Boisvert, one of our pro client guides here at I&E. Denise has a ton of experience with infinite banking and high cash value policies. So Denise, this is something you're helping a lot of people with. And I know you've got an example right here to show people how they can pay off their mortgage early.
Absolutely. Yes. All right. So I am just really excited to show you this unique approach. It's to basically fully own your home rather than merely renting it from the bank, because that's what we're doing when we have a mortgage. We're not going to be delving into the details of an infinite banking plan or how to establish one. We have a lot of that information is available on our other videos. Instead, I really just want to maintain a laser focus on one of the biggest debt instruments that most of us have ever had, which is our mortgage. So what if I told you you could knock years off your mortgage, not by working harder or refinancing, but by simply changing where you store your money? So welcome to Chapter 9 of a new released book, Designing a Debt-Free Life. And in Chapter 9, I show you how to crush your mortgage and still keep control of your money the whole time.
Denise, so it's based on where you're housing your money. So what you're saying is somebody changes that, and that can change the entire picture concerning your mortgage.
Exactly. I am not going to be showing you how to earn more money to pay off your mortgage. I'm going to show you how to pay off the mortgage doing the same exact thing you're doing today, just redirecting it into a different place, basically. But before I show you how to pay off your mortgage using the infinite banking concept in half the time, I want to assume that you have already established an infinite banking plan and are redirecting your discretionary income and your savings goals, maybe from traditional bank accounts into your personal bank, your whole life, high cash value, whole life policy. And you're now ready to put that compounding growth into action. So we have people that are funding their policies and they're building up that cash value and they say, all right, what's next? Now what can I do with this? So this is one of the things that you can do with it. So we're going to start by talking about how most people handle a mortgage. Basically, we make that monthly payment. We check off the box that says adulting, and then you assume I'm building equity. But here's the reality. You pay mostly interest for the first 10 to 15 years. Your money goes to the bank, not toward your future wealth. And by the time you build significant equity, you're locked into the property and you still don't have access to the liquid cash. So what if there was a better way? Here's the shift. Instead of shoveling all your money toward a 30-year mortgage and hoping it works out, you reroute your cash flow into a properly structured high cash value whole life insurance policy. This policy builds equity quickly, it grows tax-free, and it gives you the liquidity from day one. So once that cash value builds up, you borrow against it and send strategic lump sums to your mortgage principal. So let's just start off by comparing a traditional mortgage payment structure with a schedule designed to pay off your mortgage early. And if we look at this chart on the screen now, you'll see that in a traditional mortgage payment, you are paying, this is just for 23 years. He's already paid his policy for 7. And he has 23 years left. He's paying around $1,100 a month. And it will take him 23 years to pay that off. If he takes lump sums periodically from his cash value out of his policy and applies them directly to the principal of his mortgage, then he'll basically pay it off in 12 years. So the mortgage payoff schedule is based on payments of approximately $1,100 a month. Most people's mortgages are more than that. The balance is around $195,000. There are 23 more years left on the note. The columns on the left, again, represent what he's doing now. Columns on the right show how he can pay it off quicker. In year 3, the client's going to take $15,000 policy loan from his infinite banking plan, and he's going to apply it to the principal. He's going to do the same thing years 5, 7, 9, and 11 with $20,000 each time. The result is instead of a 23-year payoff timeline, they're completely mortgage-free in just 13 years. And guess what? They never lost the money because it was borrowed from their policy, which continues to earn interest and dividends on that money that they're sending towards their mortgage. They turned a liability into an asset and saved tens of thousands in interest.
So let's unpack it a little bit, Denise. So they were spending X number of dollars just to make their mortgage payments before. So did they reallocate some of that toward paying a premium, toward paying into a policy, putting cash into a policy?
No. So they're still making their mortgage payment while until they get that consistently. This money is coming from discretionary income and money that they were putting in their bank accounts. Now they're not doing that. They're redirecting their liquid assets into the policy to fund it.
Gotcha.
And the nice thing about this is it's flexible. If they decide in year 3 they don't want to put something to their mortgage and they want to use it for college funding, then so be it. It's entirely up to them how they want to use it.
Interesting. So they're getting so when they use this asset, they're getting guaranteed tax-free growth. They're getting the liquidity, being able to pull out those lump sums, which you wouldn't have in a lot of other places, and especially with the guarantees, right? And so that's why this is an ideal strategy for somebody that would want to aggressively pay down their mortgage.
Yes. And they're in control of that money all the time. So yeah, it's a great way to pay off your mortgage.
They don't lose control of the money, and they've got a lot of flexibility around it.
Yeah. And what is even greater is I'm going to show you what happens. All right, now we're taking the money out of our policy. What happens if we never repay those loans? So if we look at this graph here, it shows the money that they're sending to the mortgage company and their outstanding balance that they've sent to the mortgage company from their infinite banking plan is around $100,000. And they're paying the interest every year, but they don't want to pay off the loan payment. Even if they don't pay off the loan payment, they will still end up with close to, let me just scroll down here a little bit. In age 60, they will have a cash value of $470,000, even if they never pay back their loans.
Yeah.
So their cash value continues to accumulate, and they're building up for retirement at the same time. So they're paying off their mortgage and working to build wealth all at the same time.
Yeah, so for folks that are looking at this for the first time, this is because of the flexibility in policy loans and how they work. And we talk about this a lot with life insurance retirement planning, that you might have a schedule where somebody could draw X number of dollars a year from policy loans first, and that's tax-free. So we talk about tax-free retirement, but this is just, you use those lump sums to pay your mortgage off early and it can come out of the death benefit.
Right. So now listen to this. So now let's take the mortgage payment that they paid off that they don't have to pay anymore, and let's put it in our IBC policy to pay back the loans, right? They're used to paying the mortgage. They would have had to pay another 10 years. Pretend you're still paying a mortgage for another 10 years. And now they decide they're going to pay off the loans. So over the next couple of years, their loans are declining because they're paying them off. And at the end, around the same age of around 60, they will now have $578,000 in their cash value to use for retirement income, tax-free.
There you go. We got tax. So it was a good segue. I didn't even plan that, Denise, but
I know it was a surprise.
so you're doubling up. You're attacking the mortgage, and then you have tax-free retirement income, which is a very important bucket, right? When we do these seminars and webinars on tax-free retirement, a tax-free bucket for retirement is something that many people don't have. So that's very powerful.
And I just want to sweeten up the deal just a little bit more.
Oh,
we cannot overlook the benefit, the riders that these infinite banking policies have. The chronic illness rider, which acts like a long-term care rider. If you ever need health care, you can tap into your policy to get money for, home care or whatever. that is a free rider on that policy. They're not paying extra for that rider while it's on their policy. And then accelerated death benefit rider. If you ever had a chronic illness and you had 12 months to live, you can use part of your death benefit prior to death if you need it for whatever reason. So those are two extra things that you wouldn't have if you didn't have the policy above and beyond everything else that it offers. The flexibility, you can say, I'm going to do this to pay mortgage and life can happen and you just need the money for something else. You've got it. So I always like to say, this is not just a strategy, it's a shift. This isn't just about paying off your mortgage. It isn't about reclaiming control. It is about reclaiming control of your money. And it's about building a system that works for you, not just for the bank. That's all detailed in my book. I just kind of like pulled some stuff up, but it was a 35-year-old male. Yeah, and it's just a really great strategy. In my book, it's all about crushing debt and wiping out your mortgage. So I have a whole section on credit card debt, how to get that done. And we'll do another YouTube on that one, on credit card debt. And then I have another one on people that don't need to use their Social Security income.
So yeah, and we always encourage people to look at your own numbers. If this is interesting to you, if you're thinking about attacking your mortgages this way, or if you have other questions, I encourage you, wherever you're watching, there'll be a link, schedule with Denise, and look at your own numbers. Get the facts. If there's questions that you have, and you can also leave questions in the comments if you're watching this on YouTube. Happy to respond to comments and value that. If this has worked well for you, let us know. And we'll have more of these topics. I know, Denise, we're planning on talking more about this because it's so important to so many people. So with that, thanks everyone for joining us. Thanks for this example, Denise, and we'll see you all in the next one.